Today we're going to be talking about one of the better tax loopholes in existence for US-based users. It's called the step-up basis loophole. And if you haven't already heard about it, that's okay because it only comes into effect when someone dies. And while we may not want to think about our death or a loved one's death, the reality is it's going to happen to us all eventually, so we may as well plan for it. Now, normally when it comes to owning investments, when you sell those investments at a later date for a profit, you get taxed on those profits, either as short or long-term capital gains, depending on how long you've owned the asset. Short-term capital gains are essentially treated as ordinary income and are for things that you've owned for under 1 year. And long-term capital gains is taxed at a much more favorable tax rate, and it's reserved for assets that you have owned for more than 1 year. So for example, let's say that you owned $10,000 worth of stock, and several years down the road, the value of that stock has gone up to $100,000. Now the problem, of course, is that you're going to have to pay taxes on your profits. The IRS is going to take the sales price of that $100,000 and subtract from it your basis, which is essentially just what you originally paid for the asset. In this case, our basis is $10,000 because that's what we paid for the stock initially. So when you subtract the two, you made a 90 grand profit, and because you own the asset for several years, you will be taxed at the long-term capital gains tax rate. Now the tax rate depends on if you're single or married and what your overall income for the year was, but for the most part, people are going to be taxed at about 15% for long-term capital gains. So in this case, we would owe 15% of 90 grand or roughly $13,500 in taxes. But the good news is we can avoid these taxes entirely. And all we have to do is die. And once again, I get it. Nobody wants to think about dying. But like I said, it's going to happen eventually. So while I'm not really thinking about this method too much right now, while I'm still relatively young, you better believe as I start to get older, I'm going to increasingly start thinking about this as I start preparing to set my kids up for economic success instead of focusing on my economic success. So, like I said, we can avoid these taxes entirely if we die before we sell the asset. If you sell your stock 1 day before you die, you would owe that $13,500 in taxes. But instead, if you had died, your spouse or your heirs would inherit the assets on what is known as a step-up basis, meaning the basis for tax purposes is the fair market value of the asset on the day that you died. So if we go back to our original scenario, when you died, the stock was worth $100,000, and when your kids get it, their basis is also going to be $100,000. Meaning that if they turn around and went to sell it instantly, they would owe no taxes because you subtract the sales price of 100 grand from the basis, which in this case is also 100 grand. So 100 minus 100 is 0. There's nothing left to pay any taxes on. And to make things even better, any future gains are immediately considered to be long-term capital gains for your heirs. So for example, it's probably going to take you a little bit of time for ownership of your assets to legally pass on to your heirs. They may need to read through the will to determine who gets what assets. It might need to go through the probate process, etc. So maybe your kids don't have immediate access to these stocks right away, and it instead takes 2 months to formally transfer over to them. And during that time, the value of the stock has gone up even more, from $100,000 on the day that you died to now it's worth $105,000 2 months later. Now, if your kids go to sell the stocks, the same thing happens. The IRS is going to take the dollar amount of what they sold it at, $105, and subtract the basis, which in this case is the $100,000 that it was worth on the day that you died. And so the result is, of course, $5,000. So the only thing that they will pay taxes on is this 5 grand that the stock has appreciated in value since you've died. Now, normally, since they've only owned the stock for 2 months since your passing, selling it would be considered short-term capital gains, which can be taxed rather heavily depending on their overall income. But since they inherited it on a step-up basis, it automatically becomes taxed at the long-term capital gains tax rate, even if they haven't owned it for over a year. Now, it's important to keep in mind that this assumes that these stocks were held in a normal taxable brokerage account. But what if instead we had held these inside of a Roth or traditional 401k or IRA? Well, in a Roth 401k or IRA, any future gains were never going to be taxed anyway due to the nature of a Roth account. But with a traditional IRA or a traditional 401k, since you already benefited from tax savings during the year that you initially contributed to your retirement account, the IRS wants their money, and they are going to make your kids pay taxes on any gains. Inherited stocks in a traditional IRA will need to be converted into what's known as a beneficiary IRA or inherited IRA. And the rules for those are outside the scope of this video, but they will need to pay taxes on the gains. Now, that's not necessarily a terrible thing, because like I said, you already got your tax benefits in the past. With the step-up basis technique or Roth account, you had previously received no tax benefits. Now, where the step-up basis truly shines is in the world of real estate for 3 reasons. First, because unlike stocks, it's perfectly normal to own the same property for 10, 20, or 40 years, etc., and have a lot of built-up appreciation that you would otherwise be taxed on. But also, real estate is amazing because of the use of leverage, which can amplify your returns, and another concept known as the 1031 exchange. In a 1031 exchange, you can sell an investment property and use the proceeds to buy a similar investment property and defer any taxes on your gains until later. So what this means is that someone might buy an individual house as a rental property, let's just say for 10 years, and then sell it via a 1031 exchange. And then they pay no taxes on any of the profits, and they use those profits as the down payment to buy a larger building, maybe a 4-unit apartment complex. They go out and they buy a quad. Then some years down the road, they repeat this process and they sell that 4-unit building with another 1031 exchange and thereby defer the taxes yet again. And use those profits as the down payment for an even larger building, maybe a 20-unit apartment complex. And they can repeat this process as many times as they like, each time pushing off the tax burden to a future date. Until eventually they just die and their kids inherit this big 20-unit apartment building and don't have to pay any taxes on it. This method is lovingly referred to as the defer, die strategy in real estate world. You simply keep on kicking your tax burden further and further down the road until one day you die and that tax burden just magically disappears. Now you might be thinking that this technique is a joke and that it only helps perpetuate the notion that the rich get richer as a tax loophole exists so that families can ensure generational wealth. And I agree with you in theory, but in practice this loophole is almost impossible to get rid of. The current administration isn't a fan of it, and I'm sure they would love to change it, but it's actually much more complicated than just abolishing this step-up basis tax loophole. You see, if you tried to force heirs to pay taxes on these inherited assets, you would first force them to be able to prove what the cost basis of these assets were when they were originally purchased. So let's just say that you inherit a brick of gold that was sitting in your father's safe for years. You try to sell the gold, but in order for you to pay any taxes on the gains, you need to first establish what your family originally paid for it. How do you know what your dad paid for that gold? Maybe he just purchased that gold 1 month ago for roughly the same price that you now sold it for. Or maybe he bought it 50 years ago when gold was selling for about $250 an ounce. The only person that would have any idea how much that gold was worth when it was purchased is now dead. But it gets even more complicated if your parents owned a business such as an LLC. Because with an LLC, the basis gets adjusted constantly based on things like annual contributions or owner withdrawals. So if your father owned a business for 50 years, then you would need the full records for all 50 years in order to accurately find the correct tax basis. Very few people are going to keep accurate enough records dating back long enough, perhaps decades, for their heirs to ever hope to accurately calculate the correct tax basis, which makes it impractical or often impossible to do these types of calculations. And for that reason, I doubt this loophole is going away anytime soon. If you enjoyed this video, consider subscribing and leave a comment down below on your thoughts about the step-up basis and how it might help your family plan for the future. And as always, I'll see you all again next time.